Welcome back, everyone. We have some breaking news. We're going to be jumping in to Amazon's earnings report. They just reported a few minutes ago, and it looks like the street liked it. Now, I haven't looked at it yet, but it's up 11.5% after hours. And this type of jump, 11%, is typically because there is some things that investors really like to see in this report. Now, this is a bit surprising. I thought that this report could be bad because Walmart did terrible. Target's been struggling. Other retailers have been struggling. Other ad businesses, which Amazon is a massive advertising company, like Meta, actually shrunk last year, citing that the ad business is worse. And there was high gas prices and a lot of headwinds that Amazon was facing. But regardless, it looks like things are going okay. So we're going to take a look at their earnings report, but we also have Apple's as well. And after looking at Apple's and Amazon's earnings and giving my reaction, we're going to look at my portfolio. And I'll tell you which company I sold out of, because I recently just sold out of a company entirely in my portfolio. I swapped it for another one. So we have a lot to jump into. Let's go ahead and jump right in. First of all, Amazon right now, again, it's up 11.27% after hours. It looks like this is sticking. My guess is they gave both a decent earnings and a decent forecast. That'd be my assumption. Now, I have it pulled up here. This is straight from CNBC, right to the numbers. If we look at this, the first thing that I'll note on Amazon's earnings is you can't look at the EPS. You really can't, because they have the Rivian stake. And unless you exclude that, that throws the EPS off like crazy. It's the same thing with Berkshire Hathaway. Berkshire owns so much stock in different companies that as they go down and up in price every quarter, that throws off their earnings per share. So you have to look at their operating income and the operations of their business, not their earnings per share that's thrown off by investments like Rivian. They took on a large Rivian loss in terms of unrealized stocks going down in Rivian this quarter. It was almost $4 billion. Now the revenue, let's see, 121 billion versus 119. They beat on revenue. And the expectation, I believe, was 5%. So it looks like they grew a couple percentage faster, in fact, quite a bit faster than expected. The web services, another key part of this, 19.7 billion versus 19.56 billion. That's fast web service growth. I think we can look at the advertising here, 8.76 billion versus 8.65 billion. So let's throw out the EPS right now, put that to the side. The revenue was a beat, the web services was a beat, and the advertising was a beat. So far, this report looks good. But let's go ahead and jump into the actual report, and we can get some more information here. They always have the operating stuff here. We know that Amazon is losing operating cash because they invest it into their CapEx. They've doubled their fulfillment size. I've shown that free cash flow graph a million times. If you're investing in Amazon, you're investing in a company that does a ton of investments. It's not a company that just takes all of its cash flows, returns it back to shareholders. But we get to some important stuff here. The share count went up from 10.6 billion compared to 10.4 billion. So they diluted shareholders by 200 million shares. That's some decent dilution, but this is what you get if you invest in Amazon. They've been doing this for a while. That's one of the downsides. That's one of the things I don't like about it. And most of the companies I invest in do buybacks. They don't do dilution. But Amazon has enough that I think it makes up for it. The net sales increased 7%. All right, so the net sales was a 7% increase. The street was looking for 5%. So 7% is a huge beat on net sales. The street was looking for 5%, and many investors were saying it could even go negative. Things go really bad. It could be like a Meta situation where the net sales actually go down. But then we look at this here. If you exclude the $3.6 billion unfavorable impact throughout the last quarter, net sales actually increased by 10%. So on a constant currency basis, Amazon still grew with all these headwinds by 10%. That's pretty remarkable. Amazon is a growing company. I don't know how many times I have to repeat this. The people saying that it's going to stop growing, they're just wrong. They have it wrong. It's going to continue to grow. That I'm fairly confident of. Now, the operating income decreased by 3.3 billion second quarter compared to 7.7 billion. All right. The net loss here, so this $2 billion net loss in the second quarter, again, you have to factor in Rivian here. Another way of looking at this $2 billion of net loss from Amazon is they lost 3.9 billion from Rivian. So if you exclude that, if you take it out, then their net loss is really a net gain of 1.9 billion. At least I think I'm doing the math there. You can correct me in the comments if I have that wrong, but this is just live. I haven't looked at this before. I'm pretty sure they would have a net gain if you took out the Rivian loss here. And again, this is just stock they own. It's a paper loss. It just went down in price, and you have to record that. So that's the accounting rules. Now, they say despite continued inflationary pressures in fuel, energy, transportation costs, we're making progress on more controllable costs we referenced last quarter, particularly improving the productivity of our fulfillment network, said Andy Jassy, the CEO. Quote, we're also seeing revenues accelerate as we continue to make Prime even better for our members, both investing in faster shipping speeds and adding unique benefits such as free delivery from Grubhub for a year, exclusive to the NFL Thursday night football games starting September 15th, and releasing the highly anticipated Lord of the Rings the Ring of Power September 2nd. So they're doing a lot here. They have highlights here in their reports. They do this every time. Shopping innovations. If you're an investor, let me tell you something. This is just some general advice. Don't just look at the numbers. Do not just bring up the numbers in the charts and only look at their income and operating statement. Learn about the business you're invested in. You're buying a portion of a business. And if you're going to buy an individual stock, learn about what they're actually doing. Amazon is an incredible company. They do so much stuff that people don't know about. They're not aware of because they don't take the time to actually read what they're doing. But as an owner, a part owner of this company, I want to learn about what they're actually doing. So I go through and read about their Prime Day event. They sold 300 million items, 100,000 per minute. They sold 50 million more than last year. I got this wrong. I thought Prime Day was going to be worse this year than last year, and they outperformed. So that beat my expectation. They highlight a lot of other stuff here. The Grubhub membership, the NFL Thursday night football, the Amazon introduced new ways for customers to support small businesses. They have podcasts here. They have like live shopping experiences where you can live stream people shopping different items. It's really weird. I'm not into that, but it's a trend that's going on right now that Amazon's part of. Amazon announced that later this year, Amazon customers, Lockford, let's see what this one is. They receive free and fast drone delivery on thousands of items. Amazon Prime Air drone deliveries. So this company is literally starting to deliver items via drone. This is the type of things Amazon's working on. They're far away ahead of other retailers. It's not even in the same category. Amazon continues to collaborate with leading retailers and stadiums on just walk out technology. Check out free shopping for Amazon at different stadiums and different locations. They're aligning with different companies that offer this in airports, where you can literally go in. It says that you can hover your palm over the Amazon One device. Once inside, shoppers can take what they want and leave without stopping to check out. So you go in the store and you hover your palm over a device, and then you go take items and you walk out, and there's no checkout. That's pretty incredible. Another thing they're doing. Again, learn about the business you actually own. This is the reason that I'm invested in Amazon. It's more than just what you can see on the numbers, that you can see on Qualtrim or other websites. You can't put this type of stuff into a calculator and have it spit out whether or not it's a good investment. You have to learn about the qualities of the business. And this goes through a lot. I could go through all of this, but I will eventually. But they have different sections here, the entertainment they're doing. Amazon is for sure taking over sports, in my opinion. They reference the NFL here. They have the cash flow to just buy it. The Boys TV series, this one is gaining viewership like crazy. They have the new Lord of the Rings series, Prime Video, all these different shows are doing well. They're really putting their Prime Video on the map. So I'm not going to go over all of this. We could be here for 3 hours going over this, and maybe I'll do that as a exclusive sometime, but we'll just skip over a lot of this for now. The Amazon Web Services, this we might be interested in. They highlight here a lot of different companies adopting it in travel and hospitality, media and games. Riot Games is owned by Tencent. It's a great company that's using AWS now. Telecommunication companies, financial services, healthcare and life sciences, manufacturing, energy. They're highlighting that every single industry, all of them are using AWS, and the adoption is very strong. AWS added to its more than 200 products and services to help customers. They highlighted up here, by the way. Let's see. Yeah, all these new customers. It continues to be the most broadly adopted set of cloud infrastructure services. So Amazon AWS is still the most widely adopted. Part of that is because it's already so established and developers just know about it. And developers tend to use the tools they already know. You don't want to learn something new if you don't have to. So if you already know AWS and that's in your toolkit, when your boss says, we want to host this somewhere, you're not going to say, I want to learn Google Cloud instead of just using AWS that I'm already familiar with. AWS strengthened its partner network to more than 100,000 system integrators. AWS announced that it remotely operated AWS Snowcone, an ultra-portable data transfer and edge computing device on the International Space Station to process data on orbit for the first time as part of the private Axiom space mission. Okay, so Cathie Wood tells us, and different people tell us, that these companies aren't the innovative ones. These are the old boomer stocks that aren't doing innovations, and the innovative companies are Teladoc, Robinhood, and Coinbase, Shopify. Those are the innovative companies. Here we have an Amazon's earnings report, them saying that they're now doing AWS Snowcone, an ultra-portable data transfer and edge computing device, literally on a space station. This is a company that does innovation. They're making checkout-less shopping, where you can just put stuff in a cart and bring it to your car without going to cashiers or self-checkout. This company is doing all sorts of innovations. So when people say Amazon and Apple, these are old companies that aren't innovating, you know that they don't know what they're talking about. Investing in employees and workplace. This is for sure just a section of the report that says how good of an employer they are. They're going to brag about that for a minute. Supporting communities and the same thing. We support the communities. We're a great company. They have to brag about this stuff and say what they're doing. Protecting the planet. Amazon is saving planet Earth, like every other company tries to pretend they're doing. Financial guidance. All right, let's look at their financial guidance. This is really important. The third quarter of 2022 guidance. Net sales are expected to be between 125 billion and 130 billion, or to grow between 13 and 17% compared with the third quarter of 2021. This guidance anticipates an unfavorable impact of approximately 390 basis points from foreign exchange rates. So this is 13% to 17% that they're projecting growth. That's factoring in foreign exchange. That's with that factored in. This is a fast-growing company. They're projecting good growth. Meta, for example, just projected another quarter of declining revenue. Amazon is projecting 13 to 17% growth. That is very strong. Operating income is expected to be between 0 and 3.5 billion. The guidance assumes, among other things, yada yada. The businesses stays the same. They don't do any acquisitions. Now let's go ahead and break down the different segments of Amazon. They have this on page 16 of the earnings report. If you want to follow along or look at this yourself, I would recommend, if you're investing in any company, to look at their breakdown and see what's going on with the business. Their net sales in North America was 10%. So they grew net sales here pretty strong. Net sales year-over-year growth decline, excluding FX and international, was down 1%. So 1% actually decreased, but North America was very fast growth. Overall, it's a lot of growth. AWS net sales increased by 33%. That is on the high end of what the analysts were expecting. They were expecting like 31 to 33%. So 33% is very good growth. Now, I'm not sure why. This is a little bit concerning here. I'll move down so you can see this. Their operating margin percentage of AWS net sales actually declined a lot. It went from 29.8% in Q4 of 2021. Then it went to 35%. Then it went back to 29%. So this operating margin is jumping around between 35 and 29%. It seems to hover somewhere around the high 20s, the low 30s. But I'm not sure why. I don't know what makes this go around quarter to quarter. It could be reinvestments or different things they're doing. But the operating margin is now 29% for AWS. Overall, I love this report. And of course, I'm invested in Amazon. I'm very bullish on this company in the long term. But this report really does reinforce my view on Amazon's future. I'll say it again. I'm going out on a limb here and I can't see the future, so invest with your own risk. But I think this company will double over the next couple of years. That's my prediction on it. Look at the relative strength here, even in some markets that other companies operate in. They mentioned here on CNBC that ad revenue climbed 18% in this period. Facebook's, meanwhile, recorded its first ever drop in revenues this week. So Amazon's ad business, and I've said this many times, is much better than Meta's. It's better than Facebook's. People will fight me on that. They say Facebook knows ads. They've been doing this forever. It doesn't matter. Amazon runs an ad business on a selling platform. We have a button that you can click buy right after clicking on an ad. There's no way that Facebook can compete with this. Furthermore, ad revenue from Amazon has nothing to do with Apple or tracking people across platforms. So Facebook has to track people to figure out their interests in any given moment and try to infer through deductive reasoning, through scraping your private information, what you want to buy. Amazon literally has a search box that you type in what you want to buy. Their ad business is superior. So if you want to have a superior ad business, I think Amazon's a better business. Now, they forecasted another decline, that's Facebook, and Alphabet's advertising growth slowed to 12%. So Amazon's growth in ads surpassed both Facebook and Alphabet. And I think that will continue for a very long time. And it surpassed YouTube as well, but that's kind of stated there. So overall, right now, I have no reason to be disappointed in Amazon's earnings report. There's nothing I can find that's concerning. There is something that I'm missing. If I have any blind spot here, highlight it in the comments. Let me know. It's a little bit more predictable of a company. I know Apple's typically going to do okay. There's a lot of people questioning it. It's Apple. I don't really pay attention to their earnings report quite as intently as I do Amazon, because Amazon's such a more diverse business. Apple beats on revenue and profit, expects growth to accelerate despite pockets of softness. This is what you would expect. Apple is a good company. People should know this by now. Earnings per share of 120 versus 116. It was beating estimates there. Revenue, 83 billion versus 82.8. They beat revenue. iPhone revenue, a lot of people were expecting. I was hearing talk on CNBC, talk online of them selling less iPhones than expected. They said 40 billion in iPhone sales compared to 38.3 billion. Service revenue, 19.6 billion versus 19.7 billion estimated. They missed on the service revenue a little bit. Other product revenue, 8.08 versus 8.8. They missed on that. Mac revenue, 7.38 versus 8.7. This might be the slowdown that people are looking for in different devices. Their other revenue, services, was down slightly. Mac revenue was down. iPad revenue was a beat. So they did sell iPads. Gross margins, 43.2% versus 42.61%. This is one of the most important parts of the company. Apple maintains that 40% gross margin. They do it no matter what. So overall, I'm not going to go into much detail on Apple's report. It's a great company. I plan on holding it for a long time. I do think it will be market beating. I have no problems holding that company. Now, moving on, I want to go into a couple other companies that reported earnings and my reaction to them. First of all, another company, and I'll just bring this up here. This is a company people tell me about that's so cheap, and it's just a cheap company. It's a value company, and I haven't bought it yet, which is Intel. Let me zoom out a little bit. Intel here is down around 7% after earnings. The only thing that I want to highlight from this is because a company has a low PE ratio does not mean that it's cheap. Another way of saying it is it may be cheap for a reason. Intel is a cyclical business that works as a hardware maker, that relies on long-term contracts with different companies, that has a fierce amount of competition. So when I look at this company, it might seem like an easy buy because it has a PE ratio of 6.6, but I'd rather buy Microsoft with a 25 PE ratio. I think Microsoft is more cheap than Intel in terms of what you're getting and what you're paying for. And if anything, I think the company like Intel is cheaper for a reason. Not trying to bash investments here, but this is just a different investing philosophy. I try to focus on companies that are more high quality, and I'll pay up to do that because I think over time, they will have better results. Another company that reported earnings, and this is one that I actually own in my portfolio, was Meta. The company that I sold out of is Meta. I exited completely out of Facebook. I only owned $2,000 of the company, and I sold it basically flat at a $50 gain. So it really didn't affect my portfolio too much. I just traded it flat mostly. But the reason that I sold Meta, and I know a lot of people are going to disagree because they'll look at the PE ratio and investors will say, Joseph, it's a cheap company. And the companies you're buying like Microsoft and Apple are overvalued because Meta is at a 14 PE ratio. Not anymore, by the way. Their earnings are forecast to go down, so their PE ratio is going up to 17. But regardless, it's below a 20 PE ratio, and Microsoft's at a 25. So Microsoft is more expensive. Again, this is a debate between what you're paying for and what you're actually getting. When I look at Meta, and I read through their last earnings report, I thought it was a pathetic earnings report. I did not like anything that I saw. The company's shrinking. The revenue went down 1%, but the expenses went up 22%. The employee headcount went up 30%. The CapEx is exploding, and the free cash flow is going down. All the free cash flow is being ate up by expenses related to employee compensation, stock-based compensation, new expenses in capital expenditures, leasing, to Reality Labs, which is a long shot, something that's unproven. You're taking a huge risk if you're investing in Meta on the basis that Mark Zuckerberg can make everyone want to wear headsets all the time and be in a fictional world. I just don't like the investment thesis. And when I saw this report, the one thing that I was invested in Meta for was a cheap company that could use its enormous cash flows to buy back shares. But what I saw was a company that its free cash flow is going down dramatically. $4.6 billion. And then out of this $4.6 billion, that's the remainder, almost all of it is being eaten up by expenses related to stock-based compensation. So the one thing that I really liked about Meta, I think the strongest part of the thesis is a cheap company with high free cash flow that can use its free cash flow to buy back shares. But they're not even doing that to the extent I'd like. And because I'm not bought in to the whole metaverse thing, I don't really care about that. I think that it's very risky, unlikely. I decided to move on from it. The company that I bought in replacement of Meta is a company that might be unexpected. It's Berkshire Hathaway. That's what I replaced it with. I think the company's undervalued. I think the company will beat the S&P 500 for the next 10 years. It's not as dramatic as a stock pick as Meta, but Berkshire Hathaway is doing a lot of new things that I like. First of all, they're investing in tech companies. They're doing that more frequently. They have a huge investment in Apple, which is a company I'm incredibly bullish on. They generate an incredible amount of growing free cash flow. We can look at that right here. So on a free cash flow per share basis, this company grows incredibly fast. If we look at the shares outstanding, this is something new that Berkshire Hathaway has started to embrace. They're just starting to do share buybacks. This has been something recent that Warren Buffett has grown to like, and he historically has not done this. So now whenever the stock price goes down in Berkshire, he just buys back the shares. And unlike so many other companies like Meta that bought back their shares aggressively when it was super expensive, or Starbucks that bought back their shares aggressively when it was expensive, or JP Morgan that bought back their shares aggressively when they're expensive, Berkshire Hathaway's smarter. They don't do that. They wait for the stock to take massive dips, then they aggressively do buybacks. They are better timers in terms of doing buybacks and doing them at valuations that are lower rather than higher. So when Berkshire becomes overvalued, when the price to book goes up to 1.5 plus, they halt the buybacks. They don't do them anymore. They look for different investments in different companies. They build up cash. Then if the price to book value ever goes below 1.2, they start buying back their shares aggressively. So I like the buyback policy. I like the businesses that Berkshire is in. I think it's a resilient company. I think I have almost no chance of losing money over the next 10 years, and I have a very good option of beating the S&P 500. Another thing I'd recommend doing is learning a little bit about their insurance operations, because the way that Berkshire has operated, the way that they've been able to beat SPY for a long time is not through incredible stock picking, but it's actually through their insurance business. They have what's called float. It's like free money from their insurance operations that they can invest, and they can use that as leverage for their portfolio. So it's like a safe way of doing leverage that only Berkshire has been able to do. Other companies can't replicate it. So I replaced Meta with Berkshire Hathaway. That's the latest change. And I'm very happy with how Amazon's performing, because overall, Amazon is by far the most important company in the story fund. Now, that's all for now. I hope you enjoyed the episode, and I'll see you in the next one.